Hello and a warm welcome back to Screen Teaches. You're watching the very first video of our RBI Grade First 2 course, and I promise you we are just starting at the exact right place. Today's topic is National Income Accounting is the grammar of macroeconomics. Once you can speak this grammar fluently, every later topic in the economic and social issues paper, whether it's related to growth, inflation, or fiscal policy, the external sector becomes dramatically easier because all of them are ultimately measured in the language we build today. Here is my honest promise for the next few minutes. By the end of this video, you will be able to do four things without hesitation. 1. Define national income precisely and explain why is it a flow and not a stock. Also, number 2 will be that you will be able to move confidently between GDP and GNP, NDP and NNP, and between market price and factor cost. 3. Explain and apply all three methods of measuring national income. And 4. Tell the examiner exactly what national income fails to capture because in a descriptive paper, the limitations are where the marks hide. So, before we begin, let me handle you another some very important thoughts. But for that, keep a paper and pen handy for your study. We will build three conversion bridges today, and if you memorize just those three, you can solve almost any numerical the RBI throws at you. Before we dive in one word on why this matters beyond the exam hall, also, as a RBI grade officer, you will read and interpret these very numerous numbers, whether it's GDP growth, the deflator, sectoral GPA in monetary policy documents, in the economic survey, in the central bank's own bulletins. The RBI is not testing whether you can recite a formula. It is testing whether you can think like someone who will one day help steer the economy. So, as we go, I will keep linking each chapter and concept to how it shows up in real policy. Treat this hour as your first day inside the machinery of macroeconomic measurement. Let me motivate the whole topic with a simple question. How do you measure the size of an economy? You cannot put a country on a weighing scale. You cannot count its activity by eye. The economy is millions of transactions happening every second. A farmer selling grain, a software firm exporting code, family buying groceries, a government building a road. National income accounting is the magnificent feat of measurement that takes all of that buzzing complexity and distills in it a handful of numbers that lets us compare this to last year, India to other nations, one policy era to another. When you read a headline that says the economy grew at 6%. That single figure is the end of an enormous, carefully designed accounting system. Our job today is to open the hood and understand how that system works, and just as importantly, whether it falls short. Let me show you the roadmap of how we traveled. We begin with the core concept of national income and the circular flow of income. The idea here is that the entire topic together, when we meet the key aggregates GDP, GNP, NNP, NDP, and all other important distinction between market price and factor cost. Third, the three methods of measurement, as you can see here, is product, income, and expenditure. Fourth, the difference between the real and nominal output and the GDP deflator. Fifth, the Indian context, which is very important. Who actually measures all this? What is the base year and what changed in the 2015 revision? And finally, the limitations of national income and how the RBI tends to test this chapter. 6. Clean stop. Let's begin. Now, what is national income? Read this definition with me and we will dissect each and every word. National income is about the total is the total money value of all final goods and services produced by the normal residents of a country during an accounting year. Four ideas are buried in the sentence, and the RBI loves to test each one separately. So, what we are going to find here is that first it is about the money value. We cannot add 10 kilograms of rice to 50 meters of cloth to three haircuts. They have different rules and different units. So we convert everything to a common unit, which is the rupees. National income is therefore always expressed in monetary terms or in money terms, which immediately raises a problem we will solve later. What happens when prices change but real output does not? Second, it is a flow concept and not a stock concept. The stock is measured at a single point of time, the balance in your bank account right now. The flow is measured over a period, the salary credited during the month. National income is a flow. It is produced over one accounting year, which is in India especially runs from the 1st of April to the 31st of March. Wealth is a stock, income is a flow. The examiner will sometimes try to trip you on this exact distinction. Okay. Third, final goods and services only. This is the single most common source of error for beginners. Consider bread sold to a consumer, that is a final good, but the flour the baker bought to make it as an is actually intermediate good. Its value is already embedded in the price of the bread. If we counted both the flour and the bread, we would be double counting. So, national income includes only final products or equivalently, only the value added at each stage. Hold that phrase value added. It returns when we discuss the product method. Fourth, by normal residents. Note the word residents, not citizens. A normal resident is someone whose center of economic interest lies in the country, regardless of nationality. And an Indian citizen working in Dubai for 2 years is not a normal resident of India for that period. A foreign executive running a factory in Pune for several years is. The distinction is the seed of the difference between domestic and national income, which we will formalize shortly. Okay, so let me make the double counting point unforgettable with a tiny work example, because this is where the beginner's bled marks. Imagine a loaf of bread reaching your table, okay, and it reaches your table through four hands. So, what do you think happens next? A farmer actually grows wheat and sells it to a miller for 10 rupees. The miller grinds it into flour and sells that to a baker for 18 rupees. The baker bakes bread and sells it to a shopkeeper for 30 rupees. The shopkeeper sells it to you, the final consumer, for 40 rupees. Now, what is this loaf's contribution to national income? The naive answer is to add up every transaction, 10 plus 18 plus 30 plus 40, which gives how much can you say? Well, it's 98 rupees. That is badly wrong because the wheat's value has been counted four times. The correct answer is just 40 rupees. The value of the final good are equivalently at the value added at each stage. 10 by the farmer, 8 by the miller, 12 by the baker, 10 by the shopkeeper. 10 plus 8 plus 12 plus 10 equals 40. Same answer. This is the whole logic of final goods and value added. Once you have seen it as a number, you will never double count again. Now let's understand the circular flow of income, why the three methods must agree. So let's do it. Now, the single most important idea in this whole chapter, the circular flow of income. Picture two actu- actors in a simple economy, households and firms. Okay, and households own the factors of production, whether it is land, labor, or capital and enterprise, and they supply these to the firms. In return, firms pay them factory incomes, rent for land, wages for labor, interest for capital, and the profit for enterprise. Households then take that income and spend it buying the goods and services that firms produce. Look at what this creates a circle. Goods and factors flow one way, money flows the other. Okay, so what you have to think about is we can measure the value of what is produced through the product method. We can measure the income paid out to produce it through the income method. Or we can measure the expenditure on what is bought through the expenditure method because it is the same circular flow that is happening. Now, all three must give the same number. Production equals income equals expenditure. This identity is not just a coincidence, it is the architecture of national accounting. Whenever you feel lost later, come back to the circle. Now, let me add one layer of realism here. So, the realism would be that because the simple two sector circle is not the whole economy and the RBI may probe this, in the real world, money leaks out of the circular economy, or you can say circular flow, and it is injected back. The three leakages are mostly about the savings and also taxes and imports, money that households earn but do not pass straight back to domestic firms. So, the three matching injections are investment, government spending, and exports. Money that enters the flow from outside the household form loop for the economy to be equilibrium, total leakages must equal total injection. Savings plus taxes plus import equals investment plus government spending plus exports. This is not just bookkeeping trivia, it is the conceptual seed of the entire expenditure method and of macroeconomic policy. When you later study fiscal and monetary policy, you are really studying how the government and the central bank manage these injections and leakages to steer the economy. Keep that picture in mind. The circular flow with these three taps out draining and these three taps pouring in. Now let's move on to the next part, the key aggregators. Okay, so we start with our first conversion bridge. The word domestic refers to a place, okay, and the geographical territory of India. Domestic output is everything that is produced inside India's, what you can say, is India's boundaries by anywhere, whether Indian or foreign. The word national refers to people, the normal residents of India. National output is everything produced by Indian residents wherever in the world they happen to be. Convert from domestic to national, we use the net factor income from abroad or NFIA. NFIA is the factor income earned by our residents abroad minus the factor income earned by the foreigners inside our country. So national equals domestic plus NFIA. Write that down and box it. It is the bridge number one. For most developing economies, including India, NFIA tends to be slightly negative because foreigners earn somewhat more from their investments rather than our residents earn abroad. That means India's national income is usually a little smaller than its domestic income. Let us now build GDP word by word. Because the words are the concept, product means the sum of values added across all producing units. Domestic means now watch how cleanly the three aggregates fall out using just two operations. Operation 1 add NFIA to move from domestic to national. Okay, so operation 2 is subtracting. As you can see, it is about subtracting what? Well, it is subtracting depreciation. As you can see here, to move from gross to net. That's it. GDP plus NFIA gives gross national product, which is GNP. Now, GDP minus depreciation gives net domestic product, which is NDP, and GNP minus depreciation, or equivalently NDP plus NFIA, gives net national product, NNP, four aggregates, two switches. If you can flip those two switches in any order, you have mastered half this chapter. And here is a bridge number two, the depreciation bridge. Net equals gross minus depreciation. Okay, so box it. Now, what we have new as here is about the market price versus factor cost. There is one common dimension. Easy, every aggregate can be measured in two ways. At what price or at that we have to see. So let me tell you what these two ways are. At market price or at factor cost. Market price is what the buyer actually pays at the counter, but that price includes indirect taxes like GST and it may be lowered by subsidies. The income that actually reaches the factors of production like the wages, rent and interest and profit is the factor cost. To move between them, we use net indirect taxes as you can see here. Well, let me tell you one more thing that you have to keep in mind. So, the net indirect taxes is actually indirect taxes minus subsidies. Okay, so factor cost here equals market price minus net indirect taxes. That is bridge number three. Three bridges now. National equals domestic plus NFIA. Net equals gross minus depreciation. All right. And factor cost equals market price minus net indirect taxes, which we have learned here just now. So almost every numerical in this chapter is simply these three applied in a sequence. Now we need to focus on something called as a quick but exam relevant refinement that came in with India's 2015 revision. Output at the level of individual sector is now called as gross value added, which is GVA. It is the value of output minus immediate consumption. India reports sectoral GVA at basic prices. Climb from GVA at basic prices up to GDP at market prices, you add product taxes and subtract product subsidies. So you do not need to memorize every tax category for a descriptive answer, but you should be able to state clearly that since 2015, India headlines GDP at market price and reports sectoral output as GB at basic prices. That single sentence signals to the examiner that your knowledge is current. Now, we will move on to this segment where we will learn about what we call as the three methods of measurement. Now, method number one, the product or value added method. Recall the circular flow of income. Our first vantage point is production. The product method, also called the value added method, sums the value added by every producing enterprise in the economy. Value added equals the value of a firm's output minus the value of what we call as the value of the intermediate consumption. So, what you now need to focus on is that what we are subtracting here is the value of intermediate consumption, which is goods brought from others. By counting only value added, we automatically avoid the double counting trap that we discussed earlier. For convenience, we group all producers into three sectors. The primary sector is a nature based one related to agriculture, forestry, fishing, and mining. The secondary sector transforms raw materials, manufacturing, construction, and utilities like electricity and water. The tertiary sector of services includes trade, transport, finance, information technology, and public administration. In modern India, the tertiary sector contributes the largest share of GVA, a fact worth remembering because it links straight to the structural change story we will tell in the later videos. The one warning that always applies to this method is that never add gross output stage by stage, only at the value added, okay? Or you will end up counting the same thing many times over. Now, method 2. Method 2 is about the income method. Our second vantage is about income, the payments made to the factors of production. There are three components: compensation of employees, that covers wages, salaries, and the employee social security contributions. operating surplus that covers the income from property and entrepreneurship, rent, interest and profit, and mixed income that covers the earning of the self-employed and incorporated enterprises, your local kirana shopkeeper, the immediate electrician, whether it is genuinely hard to separate wages from profit. Add these three together and you will get net domestic production at factor cost. Notice it lands you at factor cost because factor incomes are by definition what the factors receive. To express it as a market price, apply bridge 3 in reverse and add the net indirect taxes. Okay. Now, for this method 3, it's the expenditure method. On third vantage point is expenditure. Total expense, what we do is the total spending on final goods and services. This gives us the most famous identity in macroeconomics. GDP equals C plus I plus G plus net exports. Let me unpack each of them. Now, first is private. C is for private final consumption expenditure, everything households spend on goods and services. I is investment, formally gross capital, fixed capital formation, plus everything in inventories, spending by firms on machinery and buildings, plus the change in stock. G is government financial consumption expenditure, what the government spend running schools, hospitals, defense, and administration. And the final term X minus M is what we call as the net exports. Exports minus imports. We subtract imports because they were produced abroad, not domestically, even though Indians spent on them. Commit this identity to memory. It reappears in fiscal policy in the external sector and in nearly every applied question on the Indian economy. Take a breath here and appreciate the elegance. Three completely different ways of accounting what is made, what is earned, and what is spent. And in a consistent set of accounts, they must all produce the same total. This is the discipline of national income accounting. Now, there are precautions for the examiners is checking for that you have to be careful about when you are solving these questions. Okay, now we have to discuss something real quick. Can you guess what it is? Well, it's about the real versus nominal and the deflator. Remember the problem we flagged at the very start that national income is measured in money and money's value shifts when prices change. Here is what we solve it. Nominal GDP values output at the current year's prices. The trouble is that, guess what can be the trouble? Well, the trouble is that nominal GDP can rise for very two different reasons. Either the country, well, either what happens is just either the country, or we can say the will the country genuinely produced more, or prices simply went up. A leader would boast of rising nominal GDP in a year when the country actually produced less purely because of inflation. That is misleading, and economists refuse to be misled. So we compute real GDP, which values output at the price of a fixed base year. By holding prices constant, real GDP isolates the genuine change in the quality of goods and services. When you hear that Indian economics grew by some percentage, that figure is almost always real GDP growth after inflation has been removed. This is the honest measure of whether an economy is actually expanding. And there's a lovely product by product. Divide GDP by real GDP. Divide nominal GDP by the real GDP, as you can see here, and you can get the GDP deflator. It is a price index that covers every single good and services in GDP. It makes it broader, where and even then the consumer price index, which tracks only a household basket, or the wholesale price index, which tracks wholesale transactions. The deflator is the most comprehensive meaning measure of the economic wide crisis we have. Expect the RBI ask you to compare the deflator with the CPI and WPI. So remember its defining feature, widest coverage of all prices indices. A quick real versus numerical is something that will help you in this course ahead. Now, we have to understand about the Indian context. The context, you can say, who measures it? Well, who measures the national income of India? The theory is that it is only half the marks. The RBI rewards candidates who know the Indian institutional setup. National accounts in India are compiled by the NSO, which is the National Statistical Office, which sits within the Ministry of Statistics and Program Implementation. Well, they release a sequence of estimates throughout the year. Advances for estimates first, then provincial, then revised as more data flows in, along with quarterly GDP figures. You do not need every release date, but you should always be able to hear the name of MOSPI and the NSO as the authorities because a descriptive answer that names the institution reads far more authoritatively than the one that does not. So, the current base for the constant price or real series is 2011 to 12. A move to more recent base the year has been under active discussion, and you should phrase this carefully in the exam. State that the present base year is 2011 to 12 and that a revision is under consideration rather than asserting a date that may have changed. The 2015 methodological revision is the other landmark. That is when India shifted its headline GDP to market prices and adopted GVA at basic prices for sectoral output. Knowing the what and why of 2015 is high value. Now, from national income to disposable income. In this segment, a chain of welfare linked aggregates RBI sometimes probes. NNP at factor price is what we call the national income, the headline welfare measure. From there, we can narrow it down towards what households actually spend. Private income is the portion accruing to the private sector, including certain transfers and interest on public debt. Personal income is what households actually receive after we remove the corporate taxes and the profits firms remain rather than they distribute. And personal disposable income is personal income minus direct taxes and miscellaneous fees, the money households are genuinely free to spend or save. You will not be asked to derive every line in a 1 hour paper, but recognizing this ladder from national income to disposable income lets you answer a surprising range of conceptual questions. Now, please take note of these key takeaways that we are having from this lecture. Why? Because this will help you when you are revising in the midst of the exam and you have to cover each of them very carefully. This will help you to save your time. Well, this was all for today's lecture and teaching. Please like, share, and subscribe for more updates. Thank you.